Good morning, everybody, and welcome to our very first IFRS and Corporate Reporting webinar for 2025. It's titled What's Hot and What's Not in 2025. I can tell you the Australian Open, the tennis is hot, Melbourne is equally hot, and we'll explore what's not that hot in 2025.
Sydney.
I'll be joined today by two partners. So as you know, in the past, Kevin, Frohbus and I have been presenting these webinars, but we're very excited today to welcome Dean Ardern to join us on these webinars. Between the three of us, we will be presenting all the IFRS and corporate reporting webinars throughout 2025. So good morning, Kevin. Good morning, Dean.
Good morning, Aletta. Happy New Year to you and Dean and all of our attendees. And hello, Dean. Welcome to the show that never ends.
Thank you, Kevin. Thank you, Aletta, and Happy New Year.
Kevin, we don't want to scare him off on our first webinar, so we have to behave today, Kevin. I'm saying to myself. But Happy New Year to everybody and all our regular attendees, and thank you for joining us. Now, we would like to start the webinar series by congratulating Dean on his promotion to advisory partner at BDO Australia. Dean's been working with Kevin and I here at BDO Australia for the last 5 years, and we are super excited that he's been promoted to partner from 1 January 2025. And part of his induction, he's now doing webinars, right? So, Dean, that's what we didn't tell you beforehand. So Dean's got a lot of experience. I've had the real privilege of working with him before when we both worked at the Australian Accounting Standards Board, and interestingly, we started there on the very same day. And Dean is a very educated man with a PhD, so he puts all of us to shame. But congratulations again, Dean, and welcome to the webinars.
Thanks, Aletta.
BDO would also like to acknowledge the traditional custodians of the country throughout Australia and their connections to land, sea and community. And we pay our respect to their elders, past and present, and we extend that respect to all Aboriginal and Torres Strait Islander peoples. Now, I'm in Melbourne on the land of the Wurundjeri people of the Kulin Nation, so is Dean, and we pay our respects to their elders, past and present. Now the webinars for the year. So as you can see here today, we kick it off. What's hot and what's not. But we've scheduled a number of interesting webinars for the years, and you can register for all of them up front. We've got our normal updates in May and November, getting ready for 30 June and getting ready for 31 December. But we will also in February do a little bit of financial statement hygiene, key takeaways from the 2024 reporting season. What can we learn? In March, we've got a whole webinar focusing on power purchase arrangements, of which we see a lot. Our old friend AASB 16 in April. We look in June at accounting for climate and other uncertainties in financial statements. We're looking at technology software costs in August. We're looking at accounting for Australian carbon credit units in October, etc., etc. So we've really tried to design the webinars based on what we believe are hot in 2025 or the ins for 2025. If you've got particular suggestion topics that you want us to cover, please let any of us know and we'll incorporate it into these webinars. Then we've also scheduled our monthly sustainability webinars, and as you know, 2025 the year of sustainability reporting, and therefore the focus for the sustainability webinars for 2025 is getting ready for that and working through AASB 2 climate related disclosures throughout the year. Again, you can register for that. Now, we've been running these carbon accounting masterclasses, Kevin and I. We ran it in May last year. We ran it again in November. And believe it or not, it's back. So in March, we'll be running another series of carbon accounting masterclasses. So you can already subscribe if you want to be the first to know when the new dates are. We'll launch it shortly. But I just wanted to flag that as well. So measuring your carbon footprint and coming up with that methodology and policy is critical to getting ready for mandatory sustainability reporting and the starting point. And I think that's why these masterclasses have been so popular. So the ins and outs list. I should tell the background to this. And that is that, when I spoke to my children at the end of last year and said, so what are your New Year's resolutions? Because my youngest finished school. And I said, what are your New Year's resolutions? They said, Mum, that is so old. We don't do New Year's resolutions. I said, okay, so, do you think about anything when we tick over to 2025? They say, Mum, we have ins and outs. And for them, an in is university and an out is school. And an in is running a half marathon and stuff like that. So I thought, hang on, I reckon from an IFRS corporate reporting perspective, Dean and Kevin and I are not just young at heart, we are actually young, so we're also going to do ins and outs. So a bit of rapid fire. What are our ins and outs for 2025? First of all, an in mandatory sustainability reporting. We know 1 January 2025 was a key date, and now we've got mandatory sustainability reporting in Australia. That's definitely an in. An out, Excel-based workbooks. This is Excel-based workbooks is out for carbon accounting, it's out for lease accounting, it's out for more or less everything, because we know there's so many issues around Excel. And I was looking for what pictures will I use, and I thought the sun is setting on Excel-based workbooks. So maybe that's the imagery. If you didn't get there, right, this is a very creative accountant at work. And let's celebrate investor communication about risks in operating and financial review. Kevin, I think this is one that is quite close to your heart.
Very much so, Aletta, and it kind of links to everything because communication with investors is becoming more formalized, it's becoming more timely and rapid, and it's actually affecting everybody, not just listed entities. It's kind of flowing down, and it links to the Excel-based workbooks, and it links to the mandatory reporting, because ultimately talking about your financial report is about how risks manifest. And I've been on this mission for some time. And it's also one of the reasons why on the outside is Excel-based workbooks are out, is you can't communicate about the manifestation of risks to your investors if you are running numbers through Excel, because you're not really going to be able to kind of understand that in a timely and a real world. So these first three in particular, and maybe the fourth one, which you're going to do next, all link together. Risks and their manifestation and how that actually is communicated to investors ultimately all leads to mandatory reporting, and sustainability is in. Old systems and ways of communicating are out.
For sure. Thank you, Kevin. Another out is year-end adjustments to account for IFRS. So, doing all these management accounts every month, and we believe that is what we want to communicate with management, how we manage our business. And then at the end of the year, as an afterthought, we do IFRS adjustments, similar to Excel-based workbooks. The sun is setting on these too. Another in, and this one Dean will discuss at length later, multinational tax reporting regimes, the Pillar 2 tax regime. It might be a good idea, when we were thinking ins and outs, Kevin last night flagged with me, Aletta, did you see that Trump has already withdrawn the US from the multinational tax reporting regime Pillar 2? And I said to Kevin, I expect him to withdraw from sustainability and sustainability reporting, etc., very soon. This morning, when I opened my eyes, I saw Trump has withdrawn the US from the Paris Agreement to try and minimize, temperatures to pre-industrial levels. So from an Australian perspective, a rest of the world perspective, multinational tax reporting regimes, sustainability reporting, they're in. I know Trump is also in, but let's see what happens.
Yeah, Letta,
And
can I make a kind of
yes,
a quick comment on it? I think the message of the day for all of these is going to be that the world is going to be in somewhat of a change mode this year. But I think the in is that we're not going back. We are going to be moving forward. So in is the stuff's in. It may look different and maybe it'll be tweaking along the way, but let's not look to what's happening in other countries perhaps, or even in other political systems to kind of indicate where we're going. And I think that's probably means that for the current year, an in is going to be year of change, year of volatility, and we should all be ready for it.
absolutely. Kevin, just earlier this morning, I attended a board meeting where I presented on sustainability, and everybody's taking note of what Trump is doing in the US. They asked about sustainability, and there was also a question about recent articles, which in Australia, there's some talk if we potentially get a change in government, what would that mean for mandatory sustainability reporting? And I think you are absolutely right. Maybe there's a tweak to the legislation. Maybe Group 3 entities get a little bit of extra time, or maybe they get more relief. Don't know. But if we look at the ecosystem within Australia's operating, doing transactions with Europe, working with Japan, working with Malaysia, Singapore, Hong Kong, all of them have mandatory sustainability reporting from 1 January 2025. So I can't see us really going backwards, but it's how do we adjust to the new world order around us potentially, and I think we're all figuring that out. But that was the first question they asked me this morning. Another out. It's been slowly on the way out, but I think it's out. The sun is setting. Special purpose reporting. We know there's improved focus on communicating with stakeholders and general purpose reporting. And even in a not-for-profit world, there's currently exposure drafts to get rid of special purpose reporting within a not-for-profit context. So that's another out. And in, Kevin, this one is another one that
Oh,
you've put on the radar, which you feel so passionate about. Pretty balloons for you,
I'm,
Kevin.
I'm pretty balloons. Thank you very much, Aletta. Look, exotic. I call it exotic financing, and I'm glad we put little exclamations, because I don't mean exotic like things we've never seen before. It's more about the nature of financing is changing. It is obvious everybody's trying to refinance, trying to raise new funds, and have new, let's say, exit strategies in the buildings. IPOs are so out, but private equity is so in. And that's leading to the way we finance businesses and how we're refinancing changing. And I think I've seen everything in the last 10 days back at work for 2025. I think I've seen everything that I could possibly see for the next financial year. Global group debt restructuring. What I mean by that is where debt is coming from external financing and it's being restructured to be replaced by parent entity debt from the global entity, in the US. Um, it's all a way of actually putting your debt together and finding a better interest rate. But even club style securitized investment vehicles are emerging in places I never thought I would see them. Companies that are rolling their receivables into a vehicle, bringing investors in as a form of moving debt off the balance sheet to essentially free up borrowing capacity. We've seen this all before back in the GFC. It's all coming back again. And I guess this time we better prepared for it as an accounting standard setter, because back then we didn't have accounting rules over a lot of these things, but we do now. So what's in? All sorts of new refinancing and financing vehicles and financing collateralized structures, but we're ready this time because we actually have the accounting standards to back up how to account for that.
Yes, our relatively new IFRS 9, which is well embedded. So yes, exotic financing, refinancing. Kevin, we've been talking about convertibles notes for years, and now we've got convertible notes as an out. And I loved it when Kevin said it's so last year. because we're doing all these exotic financing arrangements and refinancing arrangements.
Yeah.
We still see from time to time some weird and wonderful convertible notes, but we're seeing less of them. And people are coming up with maybe more creative ways of raising financing. Another and I think this is something we see across all businesses, all industries, all standards, sustainability financial reporting, and that is integrating IFRS, international financial reporting standards, into systems, processes, and the broader control environment. Sustainability is a really good example of this, where there were no adequate systems, processes, and control environments, and that's coming in. But even other aspects of IFRS accounting standards to really think, get rid of Excel, let's have a system, a process, a control environment, a review environment. Let's look at IT controls, and it's very important for our auditor friends as well. So a very important thing, and I think a lot of um, a digitization and digital improvement at entities. And maybe I thought about this, Kevin. Is it maybe that AI is putting a bit of pressure on us to step up to the plate and be ready for the new world, because we don't want AI to take over. Let's get our house in order.
And
Um,
it links back to everything. Your systems just can't possibly handle the enormity of what's now required. But let's face it, new technologies are also dragging us and pulling us into the next generation.
yeah,
I haven't yet quite bought into the fact that the AIs are going to take over the world, but it certainly has dragged us further forward and will continue
correct.
to do so. And if it's not AI, it's investing in new technologies. That's probably the answer. Yeah.
Yeah, I agree, Kevin. I haven't bought into AI taking over the world at all. I too much believe in people power, but I do think they've put us on notice and on our toes, and that's why we've got this focus. Another out. I love this one. Doing nothing is really out. And what we're trying to say here is continuous improvement, whether it's around IFRS accounting standards, whether it's around carbon accounting, sustainability reporting, technology, systems, processes, risk management, communication with investors. Doing nothing or doing less is just not a thing. So a clear out is doing nothing. And then we've put in as an in, and I think this is our final in that we wanted to flag, is the consequences of high tariff global trading environment, including accounting around levies. I'll kick it off with one example, and then I'll hand over to Kevin. From a sustainability perspective, we've seen in Europe that they've started to introduce CBAM, cross-border adjustment mechanism. So if you export goods into Europe, and those goods that you export have a high or a too high percentage of emissions in it, you pay a penalty in the form of an import tariff when you import it into Europe, which therefore doesn't make it competitive in the European market. Kevin, anything to add on that?
It's an extension. Look, we all hear Trump's agenda in terms of tariffs. All I'm saying is doing global trading is going to be harder this year. That's absolutely an in, but I know we can, all adapt.
Absolutely. So that has been our quick fire ins and outs for 2025. We will now, the three of us, look at various topics from an IFRS corporate reporting perspective that we will think will be will be high in demand. There will be a lot of discussion throughout the year. Um, and it's not the last that we'll say on these topics. Actually, it's just an introduction. You'll see some of these topics. We have very specific sessions later on and already scheduled. So on sustainability reporting, and I know we've talked about this a lot, but a reminder that 1 January marks the start of mandatory reporting in Australia. Financial years beginning on or after 1 January 2025, if you're a Group 1 entity, you have to include this sustainability report in your annual report. So the first cap of the rank in Australia will be 31 December 2025 year ends. We know Europe are currently busy finalising their first sustainability reports. They have to report year ends 31 December 2024. We'll be doing some research and sharing that throughout the year so we can learn from them. So 1 January 2025, big date. As we've previously discussed, we've got the trifecta, we've got the legislation, we've got the mandatory standard AASB S2 in Australia, S1 is voluntary, and from an assurance perspective, we have the global assurance standard or the international standard, and the Auditing and Assurance Standards Board will issue the Australian version shortly, so it will be ready for 31 December 2025 assurance engagements. And another thing is the Auditing and Assurance Standards Board in December changed the phasing of assurance over sustainability reports in Australia, and I'll touch on that shortly. So there was an exposure draft, but at their December meeting, they've changed it. A reminder on what the sizes are for Group 1, 2, 3. We've talked about this before. A decision tree, this one is one that we get asked about a lot. The threshold question would be, is the entity lodging a financial report with ASIC as required by Part 2M of the Corps Act? And if the answer to that is no, then you don't have to worry about sustainability reporting. If the answer is yes, you can consider whether they're part of a group and then what size they are. But that threshold question have to be applied to every entity in the group. Now, often in private groups, there are various trusts, etc., that are not required to lodge with ASIC, and therefore you don't have to think further. They're not required to do mandatory sustainability reporting. So that very first question is the important one. Is the entity lodging a financial report with ASIC as required by Part 2M of the Corps Act? This is an overview of the reporting timeline, for Group 1, 2, and 3 entities. And this is the new one that's been decided at the December meeting. And the interesting thing here, in year one of a sustainability report, you have to do all the disclosures of AASB S2, except for Scope 3, because there's a year transition for Scope 3. So everything in AASB S2 have to be disclosed in year one, except for Scope 3. But not everything will be subject to assurance in that first year. And what they've said here is there's limited assurance over governance, a few aspects of strategy, and there's very specific paragraph references at the bottom of the screen, and your Scope 1 and 2 emissions. So your assurance requirements for the first year is quite limited in Australia. Then in year 2, everything is limited assurance, same for year 3, and reasonable assurance, which is normal audit, is from the 4th year onwards. But the other thing to flag is you can see it's not just year 1 being a particular year, so let's say 2026. They've said for a Group 1 entity, your first year is 2026, for example, but for a Group 2 entity, your first year is 27, and for a Group 3 entity, your first year is 28. So it's again different to what they've previously talked about. So the full audit will gradually come in from 29, 30, 31, depending on what group you are. So I just wanted to flag this because this is the very latest. It is a decision that was made at the December meeting. It's not in a standard that's been published yet, but this will be in the standard. So it's not an exposure draft anymore. It's a meeting highlight. It's a decision. ASIC has also come out with an exposure draft of their regulatory guide on sustainability reporting. We've provided feedback. We're waiting for the final one. I just wanted to keep that on your table. And finally, as we've often talked about, important to consider if you're a Group 1 entity with a 30 June year end, what would a roadmap look like? The maroon project streams are the mandatory streams, and the yellow one is the voluntary strategic stream. And the green blocks indicate when you'll have to do mandatory reporting. We have similar roadmaps for 31 December year ends. Please reach out if you're interested in those. So I just wanted to flag that. So a whole focus on carbon accounting, but if you look at climate-related disclosures, very important. In that red block, you need to conduct a climate risk assessment. You have to do a scenario analysis, and then you have to do financial modeling of the impact on financial statements. And we are recommending that for 30 June 25, you do a dry run. So executive board can see what this would look like, what will go to investors. It won't be going to them, but just so they can become familiar with that. So that's the various roadmaps. I'm not going to talk further about sustainability. We've got a whole sustainability webinar series, but there's a very important connection with financial reporting. Dean, at this stage, I'll hand over to you to talk about a regulatory perspective or an ASIC update.
Thanks, Aletta. Happy for you to move through to the next slide. I think a couple of things we just wanted to highlight maybe for the next 12 months. Probably one of the worst kept secrets for a long time was ASIC's areas of focus. Now, if you'd followed ASIC in the past, they often publish their areas of focus every year, and probably over the last couple of years haven't changed very much. And then last year, they sort of, the longest held secret was finally revealed, where they said, well, actually, we've got some enduring areas of focus. And those are listed there in the slide. So asset values, provisions, subsequent events, and disclosures. I'm not going to go through those in particular, but what I wanted to highlight is the fact that probably now, I think as we all knew, ASIC looked at certain things, always looked at certain particular things. I'm surprised that revenue is not listed in there as well, because that's certainly something that they do look at very frequently, but they've decided that those areas are their enduring areas. I wouldn't be surprised if revenue, joins the club at some point in time in the future, but I think later in this year, we'll be looking at impairment, so asset values will come under the microscope in this webinar series. But I just wanted to highlight the fact that now ASIC has now identified these areas and probably will be expecting that entities will be dealing with them adequately year by year, not necessarily as an area of particular interest on a year by year basis. You want the next slide, please, Aletta? As an example of that, I've just provided a slide there that sort of details the kind of things that we'd expect that ASIC would be focusing on and some of the tension areas that in relation to asset values. I think I mentioned before, we're going to come back to impairment testing this year, so maybe we'll come back to those later in the webinar series. I might ask you, Kevin, to make a comment on this, because this is probably one of the areas that we have, and certainly when we work with clients in terms of their reporting, their broader reporting, some of these conversations are a pretty common one to have. But in terms of the areas of focus, ASIC has always been an enduring area of focus, has always been disclosures, particularly around the OFR. And looking at more integrated nature. So ASIC is not only looking at detail now, they're also looking at how does all of these business things that you're involved in, not only your financial reporting aspects, but your ESG and any other aspects of your work, how do these things all now fold together in a more broader communication? So when we talk to entities about it, one of the key things we do notice is that the need to refresh these OFR statements every year for changes in their environment, changes in their individual circumstances. And a key part is really just trying to avoid boilerplate disclosures, because they're the kinds of things that really draw ASIC's attention to it, but also our investors' perspective. Kevin, I'm not sure if you wanted to add anything there.
Yeah, look, I think I've been on this journey for some time. I'm a strong believer in the fact that ASIC is actually trying to drive good business practice, good investment in systems, and good investment in investor communications forward. They're not trying to do this as a compliance regime. They're actually trying to encourage that we get better at this to actually improve the quality of financial reporting. And I have always seen the OFR disclosure as a way of essentially drawing a parallel between risks and results in your financial reports. And I think what ASIC's agenda has, they've never said it, but I think it seems to me that what they're trying to do is essentially say to all entities, if you can actually understand how your risks translate into numbers, and then you can articulate that by actually communicating it, that's good, any business should be able to do that.
Mm.
And the OFR, the problem with the OFR is it's really only applies to sort of listers, but the reality of the mandatory sustainability reporting is it's the same thing, climate risk articulated and communicated. So what's going to happen is anyone who's not doing an OFR is not going to get the runway to practice drafting an OFR. They're going to go straight from no OFR to mandatory sustainability and climate reporting. Whereas at least the listers have had practice because an OFR is really a way of talking about business risks and linking it to financial. So I think my message of the day is, even if this doesn't apply to you, you should try and do it to see if you are able to actually articulate your business risks and communicate it succinctly to investors, because that's essentially where everything is heading. And that's why I have placed all my eggs in the OFR basket over the long term.
Thanks, Kevin. That's really helpful. It's really useful. I wanted to call out this particular report. It probably slid under the radar a little bit last year. I was reading through it and I noticed something in it which I hadn't thought about that necessarily ASIC would call out, but they've called out twice in this particular publication around accounting position papers. And I've always been a fanboy of accounting position papers. I like the idea that you articulate what it is you're doing and the assumptions you've made and the basis on which you've made your decisions around the application of a particular accounting standard or requirement to a particular circumstance. Normally, we think about position papers as being relevant to when we're either adopting an accounting standard for the first time or we are looking to apply or account for a new transaction we've never accounted for. And what I've found in probably the last 12 months is that under those two circumstances are not the only circumstances that an accounting position paper is really, really useful for. And I'll give you a couple of examples. One is where, for example, over time, everyone agrees to a particular accounting treatment, but then the CFO leaves or critical member of the accounting finance team leaves and next people, some of that knowledge goes. So all of a sudden, nobody quite knows or remembers exactly what the real reasons were why they adopted it. Another scenario I experienced last year where, and it doesn't have to be the group auditor, it could be a component auditor, actually doesn't agree with a particular accounting treatment within the group that might have implications for the wider group. And so dealing with that situation where if there isn't already an accounting position paper dealing with it, how do you deal with that situation, particularly if the auditor is new? And that can be a real challenge. If there's a new auditor, it doesn't have to be the group auditor, it can actually be a component auditor. That can create challenges. The third scenario that I think is really important too is where you're dealing with a particularly pervasive or impactful part of accounting policy on the business or on the financial statements. And everyone initially agrees, and over time, there's no question, nobody has a problem with it. But then at some point in time, the entity decides, actually, I think a voluntary change in accounting policy is appropriate. Now, trying to enact that voluntary change in accounting policy might reveal the fact that, yes, everyone sort of agreed in the previously what the accounting policy should be, but they agreed for different reasons. And if they have different reasons, then they might have different perceptions on what are the key elements that have to change to get you to that voluntary change in accounting policy. So I've become a bit more of even a bigger fanboy of the accounting position paper now, because I think that it serves not only the corporate memory, but it also helps as an insurance policy against future changes that you might not be able to control and you might have to deal with. I might leave it at that, Aletta. I think we'll move on. Pillar 2 income taxes, Aletta mentioned before, that's definitely an in. I won't go into detail, and obviously the whole event, it requires an entity whole type approach and solution. I suppose the key things to highlight in here is the fact that we are dealing with a situation where some entities are likely to have to pick up more tax liability over time, or may in fact have more tax assets over time as a consequence of their arrangements. The helpful part is that it applies obviously to only those multinational entity groups that have revenue greater than £750 million, and at least of the two of the last 4 fiscal years immediately preceding the last year. So obviously it doesn't flip you straight into the regime if you have one particularly good year. You have to actually have a succession of years which ensure that you're into that. So there's some safety in that arrangement. I suppose the important part to remember is that it is actually going to affect you, if you are in that regime, it's going to affect your tax balances. I might get you to move to the next slide. Thanks, Aletta. the kind of things that I suppose the critical thing I probably wanted to highlight, it is in force now. So the legislation, the relevant legislation, was effectively substantively enacted just before Christmas, and so as a consequence, those requirements around substantively enacted in AASB 112 and IS 12 now work, and so there has to be a consideration of the impact of that. Now, obviously, the standard setters foresaw that there was going to be some challenges if this is introduced quite rapidly, and so what they did is created a mandatory exception to applying this on a substantively enacted basis by introducing the amendments, which were ultimately included in that mentioned the AASB 2023-3 amending standard. By giving everyone an exemption, it basically ensures everyone doesn't have to go run around and actually try and work out what their number is with 10 minutes to spare. But it still does does require some disclosures to be made, and so those you need to be considering, particularly at your 31st of December reporting dates if you're preparing interims or possibly annuals at that date. The one other thing I just wanted to call out is that generally the rules were adopted across jurisdictions across the world as OECD model rules, and so as a consequence there's a fair degree of consistency across jurisdictions on those. But within Australia, we actually didn't adopt one aspect of the OECD model rules, which is the suite of accounting standards that apply and the currency applies. Now, for Australia, the tax balances have to be determined based on your group's, that is your parent parent entity of the group's accounting standards, the suite of accounting standards they adopt, and their currency, their presentation currency. So it's a bit different to other rules that have been applied throughout the jurisdiction. So that may produce a few more challenges for entities in Australia when they have to actually think about applying this. They actually have to have good visibility to the rest of the group, particularly the parent entity. We can move on from that one, Aletta, I think.
So, Kevin, I think you were the lucky winner of this section, classification of liabilities as current versus non-current.
That's right. Thank you, Aletta, and thank you for handing the topic of the moment over. It's actually by no small chance that this topic has come back to me. One is I presented a few times on it last year, so in terms of the detail, there is a lot of information in our previous year's webinars on this, and also we have an IFRS in practice, which has got quite detailed information. I actually think there'll be some more literature coming out as the year goes on. The key message on this, though, is that this is now effective, so we're in. If you haven't heard of the non-current and current liability changes, that's fine, but it has been a hot topic for some time. But you don't get the leeway to implement. It's all happening. It's happening now, and it's in the current financial year. So, it's already effective. So your balances and your presentations will be changing. The other reason why it's come to me is because it's linked very clearly to my exotic financing thing. Because a lot of the exotic financing that I spoke about earlier affects eventually the presentation of the liabilities between current and non-current. So why I'm putting it on the agenda is while you're experiencing refinancing and looking at new types of ways of financing or refinancing or convertible notes or all those things, it will affect the presentation, not only in terms of reckoning and measurement, but where you put it. And that is perplexing a number of people because the rules actually do make a big difference to some arrangements. Things that were previously in one non-current presentation category will now suddenly be current and vice versa. I think the big thing here is just to point out what the change in definition is. It doesn't look substantial on the face, but really what's happened is we've gone from the yellow bit above, that's the old wording, which classifying a liability as current if the entity does not have an unconditional right to defer settlement, and you can kind of read that in your own time. But what they've actually done is tidy that up a little bit and made it very clear it's the right at the end of the reporting period to defer settlement. That is the all-important overarching thing that needs to be evaluated. I think the term unconditional right muddied the water about what the right was. And so by making it clear that you are looking clearly at the entity's rights at the end of the reporting period, that's the date and the thing you look at, the right, to defer that settlement. And then what they've done is they've added multitudes of additional paragraphs underneath it in a way to interpret some of the bigger things that keep coming up in practice. And I think those may be on one of the later slides in terms of things like covenants. So when do you evaluate the right to your covenant? Because covenants in bank liabilities don't get nicely evaluated or tested in the contract with the bank at the end of the reporting period. So you have to kind of figure out, when do you test for a covenant when your covenant evaluation in the contract is different to the year end. So there's a whole bunch of guidance on that, which I won't go into in detail now because I'm just covering high level what's going on. And then on the next slide, Aletta, there are a whole bunch of other concepts in terms of what a period of grace is versus a waiver and how that affects the evaluation. It very clearly now articulates how the borrower's intentions and expectations are evaluated in this, which is pretty much not at all. They talk about the meaning of settlement, and very nicely they have finally told us how to evaluate a conversion feature. So if a liability can be converted to equity, they've given us very clear guidance on that. And I love this because finally we have guidance on it. And now I'm telling you that convertible notes are actually out this year. So at the very time we get guidance on it, we finally are telling you that convertible notes are out. But that's not really true. The information on settlement and conversion features absolutely is still relevant because convertible notes aren't going away. They're just changing and they're looking different and they're starting to look more exotic. But, this guidance is there. And then, of course, there's enhanced disclosure requirements. And the enhanced disclosure requirements, please don't see that as just disclosure. It's actually a lot of disclosure that goes into this now because you actually have to essentially disclose a whole bunch of things around risk and around in settlement. So there's that risk word again coming up, because the things that aren't quite captured in the classification as current and non-current have to be explained in the notes. So it's not just changed disclosure. There's more disclosure, and it's more business risk focus, and it's more related to maturity and liquidity and all those sort of things that impact settlement all have to be put into disclosures now. So bit of a ramble there, but I think my takeaway from this is it's effective, it's relevant. The borrowings and exotic financing are changing. This is going to impact it. And there's a lot of information already available in our collateral on our website that can assist you. I think I'll leave it at that, Aletta. There's a link to our publication that came out last year, and I will hand back to you or
Thank
Dean.
you, Kevin. I must say, I was giggling when I saw that we said convertible notes are out, but now finally we have guidance on how to treat convertible notes from a current non-current. And you know what I was thinking about? It's really a problem of standard setting that they're always playing catch up. And I think the sections that Dean will talk about now is another example of that, where we've got in IFRS accounting standards that's not been designed for necessarily carbon credits and accounting for them, or accounting for power purchase arrangements, or accounting for cryptocurrencies, right? So we're trying to fit these new inventions into existing accounting standards. So the poor standard setters, we give them a hard time, but they've got a tough time staying up to date.
No sympathy, sorry.
You can see Dean and I used to work at the standard setter, so we are very sympathetic. Dean, back
Yeah,
to you.
yeah. Kevin might be more sympathetic if he'd spent more time with the standard setters, but anyway, that's another
That's a different story.
story.
Yeah.
Yeah. I want to do quick fire through some of these new accounting standards, principally because some of them might not necessarily be entirely relevant to everyone, or some might be just relevant to a couple of particular entities. So we might start with, I've provided a list there of the main ones that are coming up in the next 12 months. I think the key takeaways, we move to the supplier finance arrangements. This probably goes a little bit to Kevin's comments before about the exotic finance arrangements. Although supplier finance arrangements have been around a while, again, it's that standard setter catch-up issue that probably we hadn't thought about how these things work within the context of the standards. So that at a high level, very, very high level, entity decides to try and match some of its cash flows by looking for alternative finance. So maybe ensuring that they have to pay out ensuring that their trade payables are paid, but taking on a longer term debt to try and match their cash flows ultimately, maybe, as a consequence of the sale of the inventory. The key takeaways here are, have we changed the nature, and particularly the classification of our debt? So if we've gone from a trade payable to an actual liability, what's the nature of that change? So do we require, as a consequence of this arrangement, do we require to reclassify liabilities within our balance sheet? How do we deal with the timing of derecognition and recognition? So what are those things? When do they appear, disappear within our financial statements? Which is sort of related to that classification issue. But I think critically too is that cash flow presentation. So if the cash flows are moving in the background between the lender, the trade creditor and the lender, have we got a gross cash flow or a net cash flow going on in our financial statements? So if you are in this sort of arrangement, if you are dealing with this type of thing, the standards have changed to now accommodate the prospect that you have to make more disclosures and you have to think about actually how you classify those things in your financial statements. If we move on to the sale and leaseback, again, a fairly unique scenario in the sense that you don't often see it. Anybody who's in leasing arrangements, there will be from time to time they might own a lease as a consequence of financing pressures. They might decide, they own an asset, and for financing pressures, they might decide to actually sell the asset and lease it back. So continue to use the asset, but obviously, utilise some of the equity in that asset that they've previously invested. In the past, it wasn't so much of a problem. When the ISB had issued IFRS 16, they didn't really consider the implications of it. So they thought about lease liabilities and thought about sale and leasebacks, but they didn't actually think about the nature of some of those transactions. And one particular transaction popped up that people identified as causing some issues was where you sell an asset and lease it back, and the situation is where the lease arrangement has predominantly variable lease payments in it. The short answer that happens there is that if you've got a lease where you've just got predominantly variable lease payments, they're not linked to a rate or an index. Consequently, you don't have a lease liability. The payments are recognised as an expense period by period, and you don't also have an asset. Now, with the sale and leaseback arrangement, effectively, if you move into that type of leasing arrangement, you basically go from having an asset to having no asset, notwithstanding you still have a right over the leased asset. So the standard setters, that was brought to their attention, and they decided that has to be dealt with. And so as a consequence, they've made an exception for this by saying, well, actually, if you've got variable lease payments in such arrangement, you actually do have to recognise them as a liability and as the asset, which helps to also explain the sale of that component part of the asset as well. The last topic that I just wanted to cover was the fair value measurement guidance for the not-for-profit public sector entities. This is particularly an issue for public sector entities because they're often required to measure a lot of their assets at fair value. The trouble is the accounting standard wasn't written. That's the IFRS 13 or AASB 13 really wasn't written with public sector entities in mind and wasn't written with public sector entity assets in mind. Often those assets don't have identifiable cash flows. And so as a consequence, the public sector has been pushing for some time for the AASB to have a look at this and said, look, we need some more guidance. As a consequence, the AASB has provided that. So clarifying things like what's highest and best use, what's financially feasible, what market participant assumptions should be, an application of the cost approach, particularly because often you see the cost approach is being used as a proxy for fair value. On those topics, I think I'm happy to move on to the contracts for renewable electricity. Again, highlighting this one, we will come back to it in the client webinar series, so we don't want to go into too much detail here, but the key thing I probably want to highlight here is what the standard setters are trying to deal with is the fact that entities have been very recently looking to lock in their energy supply and also lock in the use of renewable energies as that energy supply. That creates volatility, usually because renewable energy, usually its availability is when the wind blows or the sun shines. So as a consequence, there is some volatility in supply, but there's also then potentially some volatility in the P&L. The entities who are trying to lock this in and protect themselves from that volatility are now found that when they try to look and account for these contracts through conventional accounting standards, they look a bit odd. So there's volatility is created when they're trying to actually exclude volatility from their P&L accounts. So as a consequence, the ISB said, look, how do we deal with this? Maybe what we need is more clarity to distinguish purely supply contracts from what would otherwise be called derivatives. And if you are using these supply contracts in a way that's being hedged, maybe we need to change and modify the hedge accounting a little bit to enable you to actually fit these contracts into hedge accounting and therefore reduce the volatility in your financial statements. So again, this is just the world is changing. The accounting standards haven't, never anticipated obviously things like these arrangements and how they work. I should mention too that one of the key parts about the volatility too is the battery capacity. And so if you don't have battery capacity to smooth that volatility, then that's obviously going to create more volatility, going forward. I think that's all I wanted to say on that one. I suppose the other thing, maybe just highlight ACCUs. Their entities are obviously looking to buy them. The accounting, there isn't an accounting standard for ACCUs. So as a consequence, we have to apply an accounting choice. And generally, we are in the world of inventory versus intangible assets. And it comes down to how, for what purpose are you holding these assets. That's probably the key sort of finding from the accounting, although I just wanted to open up to Kevin, because I know Kevin's had he's dealt with a few clients in the last 12 months that have some interesting ACCU questions and accounting considerations.
Yeah, thanks, Dean. Yeah, look, I'll just add to that the issue if you're holding ACCUs is still clearly whether it's inventory or intangibles. I think what's happening is that the purpose of holding the ACCUs in the past was perhaps quite clear from a business point of view in the past, so that the determination of whether it was inventory or intangibles was maybe easier in the past. But ACCUs are becoming far widely held for a variety of different purposes. And so I think the purpose of holding them and therefore the classification between inventory and intangibles is suddenly becoming a lot more blurred. It's not so easy to see. I think we're seeing a lot of broker traders entering into the market, which kind of starts to make the problem difficult as well, because the inventory standard does deal with broker traders as well, but perhaps didn't envisage ACCUs when they originally wrote it. But then the other thing that's going to become a big topic for this year, and I don't want everybody to get any ideas just yet, is the concept of whether there is a market sufficient enough to allow the ACCUs to be recognized as fair value under the intangible standard. Because as you know, with intangible standards, this concept of you can only recognize an intangible asset at fair value if you have an active market. So the question is, do we have an active market? And I suspect the concept of do we have an active market is going to be prosecuted probably a number of times in 2025. I don't necessarily think the answer has changed yet, but certainly we're moving closer towards that discussion having validity. Please don't run along and say Kevin said or BDO said I can do this at fair value. That is not what I'm saying. What I'm saying is the topic is becoming a topic of discussion because the way these are traded and the way the buy and sell information is recorded and available is starting to evolve.
Thanks, Kevin. On accounting in times of uncertainty, I think we've talked a lot about it today, so I probably don't want to talk too much more about it, but I probably the only thing I would say would be that we have a BDO Global publication on it, and I think it's a good publication in the sense it would help you to structure your thinking about what is uncertain in your environment and how that impacts your accounting. So would recommend that if you think that this is an issue, that you go and have a look at that publication, because I think it'll help you to sort of structure your thinking around and the questions you can ask around your accounting to ensure that you are sort of in a position to sort of be able to explain what the risks are and how those are impacting those numbers that you're reporting.
Well, thank you very much, Kevin and Dean. I must say, I always find it really fascinating that when the three of us go and do our own personal research to put the slides together, how we come up with such similar experiences, similar topics. I always think we're going to come up with wild ideas and how are we going to consolidate it into a presentation. But yet again today we've seen very similar things. I really think something that we see throughout is there's a lot of things associated, obviously, with sustainability, whether it's power purchase arrangements, making sure we've got electricity, renewable energy, whether it's carbon credits, whether it's the mandatory reporting. But then the other big theme that clearly came out is Kevin's exotic financing and refinancing arrangements that are replacing convertible notes. And we'll have to think how these new financing arrangements should be presented as current or non-current. And I suspect that will further challenge this new standard as well on what's current, non-current. So as always, Kevin and Dean, thank you very much for helping us think. If you're thinking about IFRS and corporate reporting and how BDO can help you, we are really fortunate that as of 1 January this year, we've got 6 partners nationally that look after IFRS and corporate reporting. So for many years, we've had Clark Gerald in Brisbane, who's a superstar. We've got Kevin in Sydney. I'm very fortunate to be joined by Dean here in Melbourne, Lynn in Adelaide, and Ashley in Perth. So please feel free to reach out to any of us if you want to explore any of these topics further, or if you've got suggestions for future webinars. We would love to explore that. Then from a sustainability perspective, we've often talked about that from an advisory perspective. We look at carbon footprint measurement, sustainability reporting, whether it's mandatory or voluntary, and we look at strategy. And then on the right-hand side, our audit partners provide assurance and audit services over sustainability items as well. But in particular, if you look at that sustainability advisory, the 3 things we do, you can see here how we are represented across the country. So from a carbon accounting perspective, Tom Hockman in Brisbane, Ashley in Perth, and Kevin in Sydney, and I look after Melbourne. And sustainability reporting, again, the same group of people. And then from a strategy perspective, Brett Spicer in Brisbane, Christy in Perth, Justin and in Sydney. I do strategy, but I call it baby strategy in Melbourne. When we need the heavy hitters, I bring in Kapil Kumar or Tim Riordan. So I'll just put that out so you know who to contact depending on what your need is. So finally, thank you very much, everybody, for attending our very first webinar for 2025. We look forward to an amazing series this year. We're working really hard to come with all the latest and greatest. I hope everybody enjoy the rest of the tennis, as I definitely will. And I know next week on the 28th of January, the year will really kick off. So looking forward to work to you after that. Thank you, Kevin. Thank you, Dean.
Thank you, Aletta and Dean. Goodbye.
Thanks, everyone. Cheers. Bye.